Hey everyone, and welcome to today's Explainer. Today we're going to break down an incredibly powerful, systematic wealth building strategy. We're taking a deep dive into an applied options framework that literally transforms a standard portfolio into a self-funding growth machine. Seriously, if you've been looking for a structured, mathematical way to massively accelerate your portfolio's compounding, you are in the exact right place. And of course, a huge welcome back to the entire noob selling options community. It is just fantastic to have you tuning in with us again. Now, this specific explainer, it's a proprietary playbook designed exactly for you. We know you guys already understand the nuts and bolts of options, but today we're leveling up. We're going to build your very own self-sustaining wealth engine, taking the theory you already know and structuring it for maximum long-term impact. Okay, I want you to burn this number into your brain right now. 888 Singapore dollars. That is the precise calculated milestone this strategy is engineered to hit by the year 2032. And listen, this isn't just some random number pulled out of thin air. It's the actual mathematical output of the dual-tranche execution model we are about to unpack. By strictly sticking to this 6-year blueprint, we're relying on hard structural mechanics, not market lock, to hit that exact target. So here's our roadmap for today. 1. The academic framework. 2. The vault and factory. 3. The self-sustaining loop. And 4. The 2032 blueprint. Let's dive right in. Section 1. The academic framework, dual-tranche capital allocation. To really harness the power of this wealth engine, we've got to rethink how we structure our capital from the absolute ground up. The entire strategy rests on this one foundational concept: portfolio bifurcation. You see, in traditional portfolio management, holding a single asset class with just one strategy creates this massive trade-off between growth and liquidity. So what we're doing here is purposefully splitting your portfolio into two highly specialized vehicles. Instead of treating your capital like one giant pile of money, we're segmenting it into a static core holding and an active options overlay tranche. This optimizes everything for both long-term capital appreciation and recurring cash flow. Let's look at how these two tranches actually compare to each other. Your core long-term tranche is your static hold. Think of this as a strict no-sell call zone. Its only job is to protect your high-conviction compounders from being prematurely capped so you can capture all that sweet structural long-term upside. On the flip side, you've got your active overlay tranche. This one is highly dynamic. This is where you're rolling up your sleeves, writing weekly cash-secured puts and covered calls on undervalued assets to systematically generate yield and really monetize those short-term price fluctuations. Now, you might be wondering, why do we use weekly options in that active tranche instead of the standard 30 to 45-day monthlies? Well, it all comes down to the nonlinear theta decay curve. Basically, an option's time value decays exponentially as expiration gets closer. That means weeklies operate right in the steepest part of that decay curve, which massively accelerates how fast you capture premium. Plus, this shorter duration gives you incredibly granular delta and strike control. You can rapidly recycle your gamma and theta as you pivot and respond to market shifts. When we lay out the risk-reward profiles of these two segments side by side, it's pretty clear that separating these assets builds in some serious behavioral discipline. It practically eliminates emotionally driven trades. The core tranche gives you unlimited upside potential and completely ignores time decay. Meanwhile, your active overlay tranche is out there thriving on highly positive theta. Sure, you trade some upside potential, but you get recurring income that constantly optimizes your overall cost basis. It really is a perfect alignment of asymmetric risks. So, we've covered the Wall Street math, but what does this all mean for us? What does this actually look like in plain, everyday Main Street execution? Section 2. The vault and factory. Plain English translation. To make sure these mechanics stick permanently, I want you to imagine your bifurcated portfolio as just two simple rooms. The first room is the vault. This is where you lock away your mega-cap tech winners and compounders. You absolutely never sell covered calls against them. That way, when they double or triple in value, you capture 100% of that uncapped rally. No ceilings. The second room, that's the factory. This is where you put your solid, undervalued stocks on the assembly line to grind out weekly cash. You sell puts to get paid while you wait to buy, and you sell calls to get paid while you wait to exit at your profit target. I really want this core principle to sink in for a second. The portfolio feeds itself. You don't need to inject new salary or savings. Guys, this is what ultimate financial liberation looks like. By structuring your capital into a vault and a factory, you are basically building a self-sufficient machine that runs completely independent of your day job or your external savings. Section 3. The self-sustaining loop. The closed-loop feedback concept. So how does this actually become an autonomous system? We just have to look at the closed-loop feedback mechanism in action. It's 3 simple steps. Step 1. The factory goes to work, collecting weekly option premiums by harvesting time decay. Step 2 is where the magic happens. You take that operational revenue and you dynamically sweep 70% of that cash straight over to the vault. Finally, step 3, you use that swept cash to execute dollar cost averaging. You're organically buying more fractional or full shares of your high-conviction compounders. Put simply, the factory's cash flow is constantly funding the vault's expansion. Now, the absolute game changer here is that this engine gives you incredible defensive superpowers. You're totally eliminating external funding friction. If you ever actually need cash for personal use, you just pull it from the factory's yield without ever having to touch or liquidate your foundational vault assets. And even better, it creates a massive buffer. If the broader market is just sitting flat or getting a bit choppy, normal buy and hold portfolios are just stagnating, but your active options engine, it's happily churning out 0.5% or 1% every single week, constantly lowering your cost basis and compounding your capital. Section 4. The 2032 Blueprint, reaching SGD 888,888. Okay, we've got the mechanics down, but how do we mathematically drive right to our huge target? To hit this milestone by mid-2032, we rely on a few massive growth drivers. The absolute biggest one is the accelerated velocity of capital. Because you're realizing options income weekly instead of just waiting around for quarterly dividends, you get 52 compounding weeks a year. That's 52 distinct opportunities annually to buy more vault shares. You're monetizing all that sideways volatility in the factory while simultaneously riding the massive, uncapped megatrend breakouts in the vault. But listen closely, because getting to that target requires absolute ironclad discipline. This is your strict execution blueprint. First, your cash sweep rule. Every Friday at market close, 70% of your net realized premium goes straight to vault stock, keeping 30% for factory collateral. Your put and call writing must be incredibly disciplined too. Only strike at levels you genuinely want to own or sell at. And finally, vault sanctity. This is the big one, guys. The single biggest mistake option sellers make is getting greedy and writing calls on their best stocks right before a massive rally. You must never borrow vault shares to write quick calls. The vault stays 100% unencumbered. Period. If this explainer brought you some serious value today and you are ready to construct your own dual-tranche engine, please make sure you hit that like button and subscribe to the Noob Selling Options channel. Engaging with the channel is honestly the absolute best way to ensure we can keep delivering these high-level systemic wealth-building playbooks straight to your feed. I want to leave you with one final thought as you look at your own brokerage accounts today. You now have the exact blueprint to turn your portfolio from a static pile of stocks into a living, autonomous, self-funding machine. So the question is, will you start building your factory today to fund your vault for tomorrow? The blueprint is right there in your hands. Thank you so much for joining me on this explainer, and I will catch you all next time.